Imagine as an adult, you just started to learn to play basketball 10 minutes ago, and already you are flying in the air, dunking the ball, shooting the ball like you are a god. In 10 minutes, you learned to master the game of basketball. Is this reality? Or is it just unbelievable? What believable looks like is what you're probably going to look like after you just learn basketball in 10 minutes. It's not going to be too impressive. You're actually going to look pretty much like a fool. Think about how much time it takes before you can master the game of basketball and even get to a point of the highest level of being in the NBA. 1 out of every 10,000 men who play in high school organized basketball make it to the NBA. Just like trading, it's highly improbable that you're going to become what you call a rich millionaire, a massive individual who can really conquer the world and just spend money like it's nothing. The reality behind that is slim to none. You have to get better at your craft. So let's talk about the statistic. 80% of day traders fail. 80%. So if you're not scared off yet, that means you really want to learn how to trade. So let's begin. At the bare minimum, we have to know what we're buying, right? And how does that value go up and down? And that's what we're here for. We're trying to make some money. So what we're buying is a stock or a share. What is a stock or a share? A stock or a share is a piece of a company. Now, why would a company give you a piece of their company? Well, it's simple. They need your money. So they use your money that you invested into the company to grow. They're going to grow the business, and they're hoping to be able to get more shares and have a higher value so they could reinvest. Now, before a company can do that, they need to do one thing. They have to start with an IPO. That's an initial public offering. And all that means is that they're now open to be able to sell pieces of their company to the general public. Now, you yourself can't go up to the company and give them your money and they give you a piece of their company. That's not the way it works. All of this happens in the stock market. So the stock market is who facilitates all this buying and selling. Now, again, even yourself can't walk to the stock market and give them your money. You have to be represented by a brokerage, okay? The brokerage takes your money, and they're the ones who are going to fill your orders of buying and selling if you're trading for yourself. There really is only one stock market. Now, this is where things get really complicated. There is a million different types of brokerages, or trading platforms is what people like to say nowadays. And one of the most popular ones that you've probably heard of is called Robinhood. One that's really competing with Robinhood is called Webull. Most people now should be transferring to Webull. If you're going to be doing any type of day trading, Webull is one of the only people that are going to allow you to day trade with an account less than $25,000. Okay, so a lot of the explaining that we're going to be doing is going to be done through Webull. Okay, we found our brokerage and we're ready now to start trading. Not necessarily. Remember, brokerages can opt to accept you or not. So that's one of the biggest things there. Be ready to apply. Okay, most people do get approved. And if you're looking to trade options, that's something you have to apply for as well. Okay. Amazing. We got approved. Now we got to get to work. So the first thing we have to figure out is what kind of risk tolerance do we have? Are we pretty conservative or are we pretty aggressive? And that's really going to depict how you invest your money. Before we start our day or before we plan to do any type of traveling, one thing that we always have to check is the weather. And the stock market is no different. We call these futures. And the futures are really going to give you an insight on what the market is looking like and its weather conditions, one may say. So what the heck are futures? So futures is just an agreement for someone to buy something at a certain price point at a certain time. That data is being collected throughout the whole entire day, so you have an idea of basically the forecast of what your morning is going to look like, or maybe what the day is looking like. Okay, so we checked out the weather, aka the futures. Now we actually have to check the actual news. News is going to really affect how the market is going to go up or down. So for example, if there's something really bad happening politically, or if there's a presidency or a campaign or an election, things like that really affect the actual stock market. Another big reason why you have to look at the actual news, and this is throughout your whole entire day, is because of things like pandemics. And pandemics is really not something you ever really had to strategize for, but the reality is it's 2020 now, and yeah, we are in a pandemic. So the reality is you have to know what's going on. Is there a new vaccine that's going to make the stock market go up? Are there more cases happening? COVID cases are rising. The stock market's going to go down. So the news is going to be your other source before you even begin to fire up the app. Congratulations. We are finally ready to cover some ground now. Now that we figured out a whole bunch of things, just the actual basics, we're going to jump into the actual application. As you can tell, I have Robinhood there as well. I stopped using them. I'm using Webull now for the mobile. And then from here, we're going to go and bring this back, and we're going to go into the actual watch list. Okay, so at the bottom, you're going to notice that there's watch list, markets, community, menu, and you also have that center. That center piece is going to get you where it's going to show your buying power. And what buying power is very simple. How much money do you have for the day to be able to spend on buying and selling stocks? Okay. One thing you have to keep in mind on a Webull cash account, under $25,000, you can only use that amount for only one time for the day until the funds settle the next day. So for example, I had $100 and I used $100 to buy shares, and I sell those shares in the same day and I make some money. Now I have $125. That doesn't mean I could use them today. I have to wait till the next day to be able to do that. Now that we're looking at our watch list here, how do we get all these companies in my watch list? It's very simple. We have to go in the search bar at that top right corner, and we're going to actually simply type in the name or the symbol if you know the symbol. For now, we're going to use Apple as an example. Apple is a very, very popular stock, and we're going to click on them. And then from there, you're going to see that there's a lot going on this screen. What's going on here? And the cool thing about Webull will give you analysis on a million things. So we're doing baby steps, and I'm going to go over what's really you should be looking at before you are ready to actually buy or sell anything. Okay, so now it's time to start looking at what's going on the screen. There's a lot going on here. And we're going to start with the basics. So let's start with candles. Okay, so what are candles? So if you see there's some green and some red. So if it's a green candle, that means that it's going up. If it's a red candle, that means that the stock is going down. Now there's a lot that goes into the candle. Why it looks like a candle, it looks like a candle. You got the wick up top, and then you have a body, which would be like the wax part. So the body would mean is how long it's been in that section for the most of that time in that time frame. Okay, the wick means it's how it shot up or it shot down. So that's what you really want to look at there. Okay, now all of these candles have a specific time frame. So this is a minute chart, okay? And you can select whether you would have a minute, 5 minutes, an hour, a day, a week, a month, a quarter, a year. So every single time you change this, it's going to change your chart for that time frame. So right now, this is what you call a 5-minute chart. So each single one of those candles are 5 minutes long, okay? That's going to help you really make decisions. And while you look at these time frames, is very simple. You want to see the historical data of a stock, what it's trading like, what it's done, and what it looked like maybe a week ago, or maybe what it looked like after you heard the news that they had earnings. So earnings shows what the company did for that quarter. So it's very, very important that you understand what's going on there. And those are candles. Candles are very simple. There's a lot of strategy behind candles. There's an inverted hammer. There's a million things that we could talk about, but for the most part, the basics are a time frame of each single candle, and that's all that means, up or down. Okay, volume. Volume is very, very important. I don't mean this volume right here, not on your actual screen itself. This volume is how many people, how many shares have been traded for that day. And volume is very important. You're going to find that on the right hand corner there, okay? And every single candle, right under the candle, if you notice, there's another bar there, and it's either red or green. And what that volume means is how many shares were traded in that time frame. So if it's really high, that means that share was traded down pretty high or up pretty high, okay? And that's either red or green. Now, why would you care about the volume? Obviously, the most volume that there is in a share, the faster the stock is going to go up or down. If you have very low volume and you really want the stock to go up for you to make money, the stock's not going to go up very much. And that's just the reality, how much interest and how many shares have been traded in this time frame. So it's very important for you to understand and learn the volume. So volume is an indicator that you have to look at as well before you make a decision. Now that we are on the subject of indicators, it's very important to understand what are indicators. And indicators are just data that you can collect, or it's already there. And what you're going to do with that data is make decisions, okay? And volume is an indicator. So if we actually click on indicators here on the top right corner, you're going to see that there's quite a bit of indicators that you can have there. And we're only going to talk about the most common indicators. And you have to use the indicators to develop a strategy. Again, we haven't even bought or sold yet, and we're about 10 to 12 minutes into this video, and that's for a main reason that we cannot make decisions without having the information needed, okay? So what I have up here is a very common indicator, and we're going to call that the VWAP, okay? And all the VWAP is the volume and the average for the day, and that's included in one line, and that's going to be that red line in the center. Okay, and you can change the colors. It's completely up to you what you want to do with that. Okay, and the VWAP is a very strong strategy, and I'm gonna give you an example why this is a strategy. Anything like an average or mean is the middle. So just like any average, it's like gravity. So if it's trading really high above the average, that means it's going to come back to the average at one point because it's the average. Now, if it's trading under the average, it's going to come back. So see averages just like gravity, okay? So you're going to notice even here today, you're going to notice that for the day, it took a dip here, and I'll show you. It took a bit dip here. It was at the tippity top with that green candle there, and then it went down and it hit that red. And then from there, it bounced right off that VWAP, okay? And it's basically found some kind of support. And that's all it is. See that as a floor, okay? Normally, if the stock is trading, it's jumping up and down off the VWAP. And that's going to be obvious just because it's an average, okay? That's what you call VWAP. You want to make sure you look at the VWAP before you make any decisions, guys. Now we're really starting to have some fun, guys. We're getting into the more analytical piece of this learning demonstration that we're going to learn today, okay? So now that we're going to talk about another indicator, okay? And this is something that people have a lot of different strategies when it comes to that. You're going to go to that top left corner where it says VWAP 115.70. That's just where it's sitting at, okay? We're going to go ahead and click on that, and we're going to change that to EMA, okay? And that's what you call moving averages. And I actually selected a 50-day, so it shows on that top left in blue, EMA 50, and that means that's the average for 50 days. And then from there you have EMA 10, and that's the average for 10 days. So if you notice, they are color coded. So the black is going to be the 10-day average, and the blue is going to be the 50-day average. So what are you using this for? Same situation like the VWAP. Just like anything, averages are like gravity. So it's another indicator that you're going to use to help formulate a trading strategy or a play. All right, moving right along, guys, and this is live, so you can actually see the Apple is moving up and down, and it's actually on a green candle. But we're going to move on, and we're going to look at more indicators, okay? And these are other strategies that you have to look at, okay? And the next strategy is going to be called RSI. So if you look at RSI here, you see that box that I'm moving around. I'm going to change it to RSI, okay? And what RSI is, it goes from 0 to 100, okay? And why would it go from 0 to 100? And all that means is the percentage of people buying and selling. So if you're at 100%, that means that everyone that's trading is just buying. If you're at 0%, that means 1%, that means everyone that's trading is at selling. Okay, so that's something you have to look at. Now right now, as you can tell, the RSI is at 65.27, so more people are buying, and as you can tell, that actually correlates. There's three, and actually now a red candle. That's how things move quickly. You got 1, 2, 3, 4. Those are the last 4 candles, and those are where the RSI is at. The RSI is going to go down and up just like everything on here. And one thing I didn't touch on is that top left is going to actually have that share price, and that's Apple. Okay, AAPL is Apple, and that's at 116.70, and it's up 1.42% for the day. Okay, so that's something you want to really look at. But RSI is very, very important. How you're going to use this is you're gonna basically know with the volume is jumping off VWAP. You've looked at all your moving averages, and then from there you're looking at your candles, where everything's going. Now you know how many people are buying or selling, and that's going to really help you whether the fact that a stock is oversold or overbought. And what that means is if a stock is overbought or oversold, and that's what the RSI is the indicator for, that just means that if it's at 100%, more than likely that stock is going to go down. Now, I've actually never seen 100%, so that's kind of an impossibility. But that being said, if it's oversold, that just means that that stock is probably going to go up because you have too many people selling as opposed to many people buying. Okay, so that's another indicator to look for, and you have to look at all these real time before you make a decision, guys. Well, now we're really starting to have fun here. So what are we looking at right now? We're looking at a 4-hour chart, and we know that because we know how to select the right chart. But if you notice, I have a couple lines on here that I personally have added on. And the reason why I added these lines is because I call those support levels, okay? And when we make charts, all we're trying to do is find the floor, which is the bottom, and the ceiling, which is the top. So if you could imagine, if you bounce a ball and it hits the top of that ceiling, it's going to come down. So if you bounce a ball on the floor, it's going to bounce up. So that's what you call support levels. And what we do with this information is just simple. All we know is at last time it was at 44.25 at the tippity top, the stock went down. So if you were in a position and the stock hit that 44.25, you may want to monitor at this point, or you may want to get out of that position just because you knew last time was at 44.25, it went down. So it's very, very simple. You're able to do your own charting, and that's a big deal, and this is a massive part of the preparation for the day. You would start this either the night before or the day after, or you've been having the same chart for the last week that you've been analyzing. And how you do that, it's very simple. You click on the little draw here, and you could draw a million things. You could have a trend line, horizontal line, vertical lines. You could have a whole bunch of lines, but I'm going to add another support with you guys so you kind of understand how that works. So we're going to do a horizontal line, and then from there we're going to select right here. And if you could know that area, as you could tell, this is where it's been for the day in these last couple hours. It's been in that area, and as you could tell, I could actually select to buy or sell in that time frame. So it's really, really important for you to do that and make your own support, to make your own charts, have fun with it. And the cool thing is you could bring that back and you could change that to a 1 hour, and your chart's still going to show. So it's really important. You don't have to make a chart for every single time interval. So have fun with it. Try to find your support and use this in your trading strategy so you can make some smart executive decisions, and you make some money along the way. We are back now. So why are we back at Apple? So I wanted you to see this. If you notice at the tippity top here, you see AAPL, which stands for Apple, and then it's a part of the NASDAQ, okay, and that's the market it belongs to. So it's very, very important when you're looking at this that everything that we looked at, the indicators, the news, the futures, all of that means jack if it's not following its corresponding market, okay? So we're going to actually go ahead and click on more on the bottom right, and we're going to go to dual charts here. I want you to see something which is kind of cool. So if you notice, we're going to click on the NASDAQ, which the Apple's a part of, and they tend to run pretty similar to each other if you look at this. Literally what the NASDAQ does, Apple does, which is pretty cool, and we could bring that down to an hour. And if you see that hour, charts, they're running identical. If you look at it, it's kind of crazy. So it's really, really important when you're trading that you're looking, it's corresponding, whether it's a part of the Dow or whatever is a part of that. Pretty much no matter all the news and all the crap under the sun means nothing. It really runs with the market. Those other indicators and those other tools that we use are simply just to help us with trading, but your biggest best friend is going to be the market itself. Even the best of the best lose money, and this is the harsh reality. Like I said, 80% of traders fail. You're going to see more negative P&Ls, which is profit and loss, anywhere and everywhere all over the internet. I've heard of horror stories of being negative $1 million, $2 million in a stretch of 2 or 3 days. And sometimes that compounds and you have a whole bad week, a whole bad month. So understand, no matter how good you are, there's one thing that is true. There is no such thing as a trader that does not lose money. It's a part of the game, and that's when we get to the next part, which is called risk management. This is so important. We need to figure out how much money we can allocate to lose, or how comfortable you are losing a certain amount of money, because that's just the reality. If a play or an execution of one of your ideas, after you've looked at everything under the sun and you feel like it's going to go up, but if it doesn't, things can turn on a dime. And this is a clip that really illustrates that pretty well.
There's something happening here.
This one day, we was out walking like always, and then, just like that, somebody turned off the rain and the sun come out.
Just like the weather, obviously things can change so quickly. So, and that's really what it feels like. You're in a battle. It's insanity. From there, you know, the stock was going up, now it's tanking. Or you were trying to short a position, the stock was going down out of nowhere, it's going all the way up. So understand, risk management's a big deal, and I'm going to teach you how to do that. Your number one friend when you start trading, and we're going to go ahead and enter a trade, okay? We're going to click on the trade button, and you have a couple options here. As you could tell here, you got stop, OTO, market, and limit. So this is what you call a stop loss, okay? And all that means is you're going to turn that bad boy on. And what that means is when it gets to a certain number, okay? So say your stock is going to it's going down to the downside. When it hits this number, it's going to trigger a signal. And it's going to let you, okay, sir, or young lady or lady, you have lost enough money today. Let's go ahead and sell that and not lose any more. And the reality is you have to live and die by your stop losses. A tight stop loss just means that it's tight. It's a small percentage. It could be 3%, 5%, 10%. And I think that's the biggest mistake new beginning traders do. They have no stop losses, and that's the biggest problem they run into. You know, especially when you're paying with small amounts of money. If you only have $200, you're not willing to risk those $200 in one order in one day. You lose your money, then what are you going to do? How are you going to grow it? So it's very, very important that you understand stop loss. That will be your next best friend. Okay, so this leads us to a age-old debate. Are you a bull or are you a bear? Now, I will tell you this from experience. Betting against the bullish market or betting against the bear market can be detrimental to your health and the health of your bank account. So it's important to understand what that means. So if the market is bullish, let's say for a day, a week, a month, a year, whatever the case is, that means that the market has optimism and you're optimistic that you're going up. That would make you a bull. So let's just say the market has been on a downward trajectory, then yes, now it's in a bearish market, okay? And that's bearish market conditions. And that means that you are pessimistic that the market's gonna go up. Now, you're gonna see in the comments and videos and everywhere in memes, bulls versus the bears. But I will tell you this, betting against a market that has a trend is not a good idea. Now, there are signals that you could look at, and this is very important. And there's a million types of signals, so I'm only going to touch on the most commonly used, okay? And that's a bear flag or a bull flag, okay? And then you also have bear and bull pennants. So look at these, take them in, pause your screen. It takes skill to look them and spot them out, but once you start seeing the signals, they're easy to find. Okay, guys, this is the hardest thing to do as a trader, knowing when to take profits. You have to take your profits. This is the most important thing. This is what we've done all this work for, is to make some money. And the problem is too many people sell at the wrong time. It's all based off percentages, okay? So let's just say $100 and it's up 50%. You know, you've made quite a bit of money already. It's time to sell. Same situation. If you had $1 million and it's up 10%, you made $100,000 in that position. That is unrealistic. You have to break it down. Most traders don't care about their P&L. I mean, we do, obviously, but at the same time, is you really care more for how many green versus red days you had throughout that month. The more green days you have, the better you are making a living out of this situation. You can't just gamble, make $1 million one day, lose $2 million the next day. It doesn't work that way. It's all off percentages. Take your profits. Percentages is the biggest deal depending on how much money you have and how aggressive and how quickly you want to grow. This is where the percentages come into play. But I'll be honest with you, you got to be realistic. Okay, the last basic strategy we're going to talk about is hedging. And you're just not sure which way the stock is going to go. It's going to go up or down. So the cool thing about hedging is that the stock market allows to buy on both sides. So if you really think that it's going to go on one side, that you've done all your homework and you think it's going that way, if you're not 100% sure, you can put $100 on the side that you really think is going to go up and put $40 on the other side thinking it's going to go down, just in case it goes bad, or just in case it doesn't go your way. At least you're mitigating your losses by winning on one side. So this is something you don't do all the time. Some people do it all the time, but on the reality is it's a way and a clever way to save and make money. We are on the home stretch, okay? It's time to finally start talking about what everybody and their mother wants to do now, and that's called options trading, okay? Real simple. We're going to go ahead and while we're on the screen, by this time you should be pretty familiar with the screen. On the bottom, you notice you have trade, positions, options, and more. You're going to click on options. Okay. We're going to break down options. Now, there's a lot to options, and this could be a 3-hour video if I wanted to, but I'm going to talk about just the basics, okay? So let's first talk about what the heck are options. So not all stocks or shares or companies have options available. So it's something for most of the most popular ones, and pretty much all of them at this point do. You know, somewhere around the 70% probably have options trading. And what options trading is, very simple. It's basically placing a bet. So what are you placing a bet about? You're placing a bet whether a stock is going to hit a certain number, okay? And just like you do bets, normally you put a time frame on it. So if you bet your buddy or your family member, hey, you know, the Patriots are going to win the Super Bowl by January or whatever the case is. Obviously, we know the date, because obviously we know the Super Bowl date. But let's just say a better example would be, I bet you I'm going to lose 30 pounds in 3 months. And your buddy takes that bet. So that's what options is. You're betting that a price point is going to be achieved by a certain time. Now, these are, and what you're buying are contracts, okay? So if you notice here in our screen, we have contracts here, right? And you got dates. So what are those dates for? Just like we talk about that bet, we get to choose where that date is for that bet. Obviously, just like anything, the longer time you have for that price point to get achieved, the more money that contract is going to cost, okay? And when you're buying options, you're buying contracts, okay? So when we're talking about options and contracts, there are two types, okay? You have calls and puts, okay? On the bottom, calls and puts. So calls are bets that the stock is going up. Puts are bets that the stock is going down, okay? So let's click on a date, right? We're going to click on October 30th. And now this could get really, really complicated really fast. But we're going to focus on some things right here, okay? And we're going to scroll down. And why we're scrolling down is for one reason I want to talk about. It's very, very important. It's the biggest thing ever, all right? So if you see in the middle of the screen, right, it says stock price, $116.60, okay? That is where the stock is currently. Right now it is after hours, so that right now that number will not move until the stock market opens, which you guys know opens at 9:30. So why are we looking in the center of this screen? And it's very, very important. And the reason why we're looking at the center of the screen is because this is going to depict what kind of contracts we are going to buy, okay? So when it comes to contracts, everything is times 100, all right? So what that means is if you see a number here like 328 right above that 116, that doesn't mean $3.28. That means $328. Everything's times 100. And why is it 100? Because when we're placing a bet for this share price to get to a certain price point, we're actually reserving the right to purchase 100 shares at that price point. That is the benefit why people do options, okay? They want to be able to buy and exercise that option. And what that means is we're going to be able to buy that share at $116, even though that share goes up to $118, okay? And that's at any time we could exercise that option before the contract ends, all right? But while we're still here, let's talk about that middle. There's a reason why there is a massive division in the screen there. And the reason why that is because this is going to depict whether we're in the money or out of the money. Okay, so what does that mean? All right, so when we're in the money, that means that we're buying an option that's already under the price point where it's its current value. So $160 contract, which would be this one, right? Obviously is in the money because the stock price right now is $116.60. That means that we're betting that it's already at $116. So we're not necessarily betting that it's out of the money. So anything above that actual gray line would be out of the money. That means that the share price is under the option that you're trying to purchase. Obviously, it's going to be more cost effective if you're betting out, okay? So if we get out of here and you see all the way down, right, we could go and say that this share is going to go all the way up to $130 by the end of the week. The likelihood of that happening is pretty hard and it's pretty slim to none. But the cool thing with options is what you don't realize is you don't wait to the end of the actual expiration date of that contract. The whole point why people love options is because you could really leverage your money. I'm talking about $100. You could turn $100 to $350 pretty quickly, and I mean in minutes. So all that based off of is just price points and the value, okay? So why I'm in Apple specifically is because we've been kind of looking at Apple the whole entire day. But the reason why we're looking at Apple is because Apple tends to be what you call a volatile stock. And we learned about volatility. And all that means is that it goes up and down quite frequently. And it does happen pretty violently sometimes. So if you look at the top right here, you're going to see you have a couple things. So you have the bid, the ask, the last, percentage change, and mid, and implied volatility. And that percentage just means that that particular contract has an ability to swing pretty high or up or down. Okay, so that's something you want to really look at. And why I'm explaining everything under calls is because it's the same exact methodology during puts. It's the same exact thing. It's just you're betting on the way down. But I will show you that, okay? But while we're still here, let's talk about the strike price, right? So in the beginning, at the tippity top right here, right above there, not where I'm actually clicking there, but we're going to back that up. At the top, we still have strike, bid, ask, and last, okay? So the strike price, and what that means is the number that we're actually selecting that we're betting for, okay? So $115 would be that strike price, all right? And what that means, again, is that we think it's going to get to $115, but we already know that it's at $116.60. So the reality behind that, we are buying an in the money type of a contract, and this contract already has what you call intrinsic value. Okay, an intrinsic value, all that means is that it's already has a value because it's in the money. Okay, now there's another factor that we have to talk about that's called extrinsic value, and that could get pretty complicated as well. So what extrinsic value means is the time on your contract has a value. Okay, so we talked about that already. So if we want to do a bet a year out, okay, if we back that up, oh, excuse me for a second there. Well, we back that up. Well, we got to jump back into options, and we back that up to all when it comes to the actual time frame here, and you could see that we could place a bet all the way to January, and that's pretty crazy. So it's actually January of 2023. That's 815 days out. These contracts are going to be way more expensive, and why that is because that has a lot of extrinsic value, and all that means is there's time on your contract before it expires. Okay, so for example, same contracts we were looking at $115, that's a $2,638 contract. And the reason why we know that is if you look at the mid. Okay, so let's go back, and we'll actually stay in these high numbers. So we have the strike price, and that's all the way at the top again, and that's just the number we're selecting. Then after that, you have the bid, the ask, and the last, and then percentage change and mid. Okay, that all kind of plays into the same exact thing. All the bid means is that's the number, that's the lowest number you could purchase that contract for. Okay, so when you go to purchase that contract, the most cost effective way you could buy that contract is at $2,600, right? But the mid price, which is in the center, that $2,638, if you try to fulfill an order, that's going to be the easiest order to fulfill because people are willing to take that pretty quickly. And then the ask price right here at next to the bid means that's the highest you could pay for that contract. Now, this really plays a lot when we're talking about in a real live scenario. Right now the stock isn't moving up or down, but you're going to see that bid and ask move pretty quickly, and in the morning it moves pretty quickly as well. Right when at the bell at 9:30 in the morning, things happen pretty quickly. So if you try to buy something at the bid, that contract's not going to get fulfilled, so you're going to lose the opportunity for you to try to jump into that position. So it's normally what most people want to buy at is at that actual mid price. Okay, and that's just going to guarantee you for your contract to get fulfilled. All right, so if you haven't gotten lost yet, okay, we're still here and we still got a lot to talk about. Okay, so we talked about extrinsic value, intrinsic value. We know what the strike price is, we know what the bid, the ask is, and then the last price means that was just the last price that contract was worth at or valued at. Okay, then from here we're going to go back to the mid. We know what the mid is, and then from there we have implied volatility. This is all at the top, guys. Okay, implied volatility, we know what that is. That's just a percentage of what this contract goes up or down. Okay, that's just that's what it predicts. It swings up or down. If you notice, the other one was around 70%, so it was a little bit higher, so that contract will go up and down more than this one will. Then on the next implied volatility, we have open interest. Okay, and all that means is you see at number 3,194. All that means is how many people are in these contracts. Okay, so a big strategy a lot of people like to do is they try to look for a volume, a contract volume type of scanner that just shows what people are in. And I'll tell you this right now, just because there's 3,194 people in this contract doesn't mean it's a good contract. And trust me, it could be a million people in that contract, and that contract can fail, or it could make you lose money or make you win money. Okay, so we understand that. And then from there we're going to talk about the delta, and we're going to stop there. Okay, and why we're going to stop there, the delta, all that means that 0.60 means that, remember, everything's times 100. All that means is that if the stock goes up $1, okay, so if it goes from 116 to 117.60, okay, you're gonna get in return $60 for that contract. Okay, and that's a pretty strong delta. If it was at 1.2, that just means that every single time the stock goes up $1, you make $120 for every dollar the share goes up. Okay, Then we're going to break down from there. Again, we could talk about the theta, the gamma, and the volatility is very important. But all these contract prices, if you're looking at, right, these are called premiums, okay? And that's what they're called, premiums, because someone wrote this contract and they're charging you a premium, and you're buying that premium for whether that stock hits or not, okay? So we have to also look at, just because, let's just say we went into $120, right? And the stock does hit $120. That doesn't mean that you're now what you call contract wise in a really good place. What that really means is that you have to add the premium that you're paying plus it needs to get to the actual price point, okay? And again, I'm doing a really fast and basic way for you to understand the screen. And again, there's videos out there, and if you guys want, I'll make an actual hour-long video and break everything down. All right, guys, thanks for hanging out for me for so long. This is the longest video I've ever done, but I try to boil down everything into basics. You could dive in and really open up the pages on a lot of these topics here. Listen to your rules, try to make some money, prepare, and take your time. I would highly recommend you paper trade before you do anything with your own money, but it's up to you. Till the next time, I'm your review master, and thanks for hanging out.